Hi everyone, nice to see you all and welcome to SATalks. Today we're going to talk about the hopefully interesting topic of RDR, regulation, and a number of other evolutions that are going on in the industry right now as a result of RDR. So I think to start us off, the RDR was all about core principles to upgrade our industry. If I can come to you first, please, Heather, do you think that is working, having been through the RDR in the UK, and do you have any particular insights or thoughts around that?
Yeah, sure. Thanks, Emma. It's great to be here. So I think the headline coming out of the RDR was that there was this rapid and sudden decrease in the number of financial advisors. I think it was 20% in the year the RDR was introduced. And so there was a lot of initial concern about whether the RDR was going to essentially improve the industry or whether it was going to result in a rapid, big advice gap. But what we've seen, being able to look back in hindsight, is actually the number of advisors now is higher than it was in the year before the RDR. We haven't seen massive increases, but we've recovered the number of advisors. The proportion of customers getting access to advice has increased. And it's been fantastic for the industry, for the reputation, for the focus on the customer. Of course, there's always going to be problems and niggles and things that need to be sorted out. But overall, the headline is it's been fantastic for customers. It's been a huge benefit to financial advisors who embrace the professionalism, have increased qualifications, have fundamentally changed the way that they run their businesses to earn fee income and stop getting commission. It's had a rapid increase in, or resulted in a rapid increase in assets on platforms. It's been great for the platform market, and it's driven down cost. It's hard to exactly compare costs that the customer's paying pre-RDR and post-RDR, but fund management and product costs have come down. Platform costs continue to shrink. So it's been overall a really good piece of legislation that seems to have achieved its objectives, which I think is a rare thing to be able to say about regulation, actually.
Yeah, of course. And that's really, it's nice to hear that, because we're through it. We've gone through the pain barrier of what the RDR was set about to do. But Kevin, over in South Africa, you're a bit behind us in terms of tracking exactly to exactly how the RDR was produced and deployed over here. What do you feel the same right now with advisors and platforms over in South Africa going through this?
Yeah, so Emma, again, thanks for inviting us into this session. So definitely yes. We have a bit of a benefit in South Africa in the sense that perhaps our regulator can learn from the mistakes that the UK has made in the implementation of RDR. And I think there's been many to be had. And I think everybody's sort of the view that, this regulatory cost and this imposition on financial advisors, ultimately somebody pays for that. And, have costs come down sufficient, there's been cost pressure. But, who's paying for this ultimately? And we all know the consumer pays for this, for the implementation of RDR. We've got a lot of differences. I mean, we don't have, we've always had a very strong independent financial advisor community in South Africa. Certainly our banks and our life offices have had very big advisor sales forces as well. But I think if you look at the independent market, it's always had an element of professionalism attached to it. It's a lot of people that were legal advisors in the life offices or private bankers in the banks with very good degrees, often CFA level kind of qualifications. So we've always had a high degree of skill, I think, in the profession of financial planning in South Africa. That's having said that, we have a population here that doesn't really have access to advice. If you kind of look at the numbers in South Africa of consumers and access to financial advice, we know we again juxtapose between or bifurcated between a market that's has a very big high-end element and a massive poverty segment as well. And I think the issue is that how do you make advice accessible to those that need it most? People who only have a little bit of money, a bit of savings to accumulate towards whether it's a discretionary savings vehicle or some kind of compulsory savings for retirement provisions. How do you make advice accessible to that particular audience who don't possibly have access to digital, advice models and robo models and that kind of stuff. So I think we juxtapose, we're well behind the UK curve, but I think in many senses that's a good thing. Obviously, what we have seen in South Africa is an acceleration of a number of things. Our platforms have always been very sophisticated in South Africa. And I've spent a lot of time in the UK and South Africa, and I would argue and say that some of our technology is probably even better than the UK in many respects. So we had an advanced and a mature platform industry, but equally so, the big move is of course the sub-delegation of invested mandates to discretionary fund managers. That's been a massive trend that we've seen, and whether that's been good or bad, I don't know yet. I mean, the proof of the pie is in the eating ultimately, because not all performance of discretionary fund managers is always transparent and fully accessible to the market by and large. And I think we're seeing this sort of we've seen the first DFM wave, we've seen the second DFM wave, and we're seeing now value for money, and we're seeing also a lot of retransitioning of discretionary fund managers as a consequence of that first wave being disappointing in some cases, and recontracting taking place in the discretionary fund management market. So in a nutshell, I think we're waiting with bated breath, with certainly things like advisor classification, this independent definition, what it means for the future. But I think it's probably been a good thing in the whole.
Thank you, Kevin. And before I come to Carolyn, just to ask about from a supplier's point of view, what she's seen in terms of the requests coming out of existing clients and perhaps new prospects. Can I just quickly pick up on the point that you said there, Kevin, about accessible advice? Because I'm not sure about you, Heather, but I think that wasn't one of the number one elements of when RDR happened over here. It was more that we hadn't realized that a number of people wouldn't have access to advice. That's almost been towards the latter part of where we are right now. I don't know about you, but again, I was working in that world when RDR happened, and for us, it was all about box ticking at the time. Make sure your advisors are qualified enough. Make sure you're using the right platforms, and you can justify the right platforms, and set your stall out as much that to tick the regulated box. And a consequence, I think, for what I've seen, and Heather, you know all of this, you collect all of the data, is that access to affordable advice has been a consequence sort of at the end of some of those regulations being ticked, the boxes being ticked. But is there any comment around that?
Yeah, absolutely. I think the advisors that exited the market tended to be serving people within a bank branch environment. They were tied product salespeople, and it was a really important shift to get away from a sales mentality for a financial product, because it needs to be in the customer's best interest and ensure it's suitable for their long-term goals and objectives. But at the same time, how do you get people to invest who aren't thinking about it? And I think that in the UK we've had auto enrollment, which has defaulted people into workplace pension plans, which has helped to address that, because where people were being sold a product who didn't have huge sums of money, they're now being defaulted into a pension at work and saving for their retirement. Not enough, but it's definitely a start. I think there's some really, really interesting initiatives happening now with digital advice propositions within banks to try and look at people who have high cash balances and think about how can you nudge them towards investing. And the regulator here is really focused on looking at people who have excessive cash balances and how you can encourage them to invest, because of course banks will have a vested interest in encouraging people to keep that money in a savings account or current account. So there's some interesting innovation happening on the side, but I absolutely agree the accessibility of advice was something that wasn't necessarily seen. But I will say that the latest data I've seen from the FCA, from the Financial Lives study, shows that there's been actually a 2% increase. It's not a huge number, I mean it's basically flat, but the proportion of the population population who's had access to or has paid for financial advice has actually increased ever so slightly now compared with 2013, which should give us a bit of comfort, even if we did have that drop immediately.
Thanks for that, Heather. Carolyn, from a supplier point of view, what have you been hearing from current clients and prospective clients about how they're repositioning their propositions in light of the requirements coming out of the RDR?
Thanks, Emma. So I think that the key thing here is RDR isn't new. It's been around for a very long time. As we know, it's been active in the UK market for well over 10 years. So it's almost just become something that is just part of normal requirements conversations when we are engaging with clients or prospects. What we are actually finding is that there are more general discussions around how the UK has solved for various market trends and regulation changes, which obviously incorporate a bit of RDR as well. And how have they tackled these challenges by solving it either via technology or changes to their operating models, or a bit of a combination of both. What's quite interesting, as Bravura, as a global company, our technology was adapted to cater for the RDR changes well over when it was required. So for us as a corporate, it's really more about identifying the differences between South Africa and the UK market and incorporating that into our discussion as we embark on the journey with clients and prospects. So it's more about supporting our clients as they go through the journey to incorporate the lessons learned and how that needs to be brought in to their business models as they start shifting to cater for these type of changes. You know, being a global company that has a software with a single code base, it's almost assumed that our technology actually is compliant for the respective markets that they operate within. So this really does benefit clients where we tackle new territories, and it's just about where does it vary slightly.
Yeah,
can I pick up on a point, if I may, that Heather mentioned, because I think it might be of benefit to whoever's watching this session today, is this whole concept of auto-enrollment. Because, you know, again, in South Africa, we also have that obligation. There's an obligation on the part of the trustees of a pension fund and principal office to make sure that when people, you know, are retiring or exiting a pension or provident fund scheme, that there's an element of advice, workplace advice that gets attached to that. Having said that, you know, there's also studies that have been done. I'm not sure if I think they're around the world, where it's saying that, you know, a good financial plan and good advice can add something like 200 basis points a year to consumers, you know, outcomes ultimately. So I wouldn't mind just spending a minute if we can on that, because I think, you know, we're very much in the newness of auto enrollment in South Africa, and maybe, you know, Heather might have something to either share with us that might be of benefit to the listeners.
Sorry, can I just clarify, Kevin? Is it about how to drive up the participation rate and the enrollment rates through auto enrollment? Or
no, I would just like to say, you know, has there been any unintended consequences again? In other words, you know, workplace now taking on that responsibility, whereas previously it would have been brokered in the system, and advisors, wealth managers will have access to a consumer to provide them advice on their, you know, preserving their pension fund or provident fund. But, you know, have you seen a massive shift now from, you know, consumers, you know, on that auto enrollment sort of exercise, or is there still monies going to third party, you know, advisors to advise on third party assets?
So it's a really, really good question. The studies that have been done about the value of advice tend to be with advised customers who tend to have, on average, about £250,000 of investable assets. And so they don't necessarily look at the full market, and it doesn't necessarily show what somebody with a smaller portfolio value, what the benefit might be to them. And often I think it's quite challenging because a lot of the value of financial planning is avoiding mistakes in how you withdraw the funds. So advised customers tend to defer more, but they also avoid tax mistakes. They also reduce their costs. There's a more disciplined investment portfolio strategy, and they're clearer on, you know, how you structure the portfolio from a tax minimization perspective. And for people, the I think they call it, I don't know if this expression has reached us, that Henry's the high earning, not rich yet. They tend to be a population that's not well served by financial advice in that traditional model, where it's in the UK, most financial advisors charge based on assets, a proportion of assets. And if you have people who are high earning but don't yet have that large portfolio value, the value of financial planning is still enormous, because figuring out how you fund the purchase of a property, or where you should be saving your assets, and figuring out how much you put into your workplace pension versus elsewhere, the value is enormous, but the charging structures need to change. And in terms of auto enrollment, I think one of the issues that exists in the UK that I'm hoping will be fixed is that advisors can't always advise on the workplace pension as part of the overall financial planning. They can, but in terms of how the fees are levied, you can't take a fee from the workplace pension unless it's about advice on that workplace pension. And if you're advising somebody in accumulation about overall financial planning, it's hard to justify how that fee applies to the workplace pension specifically, because it's an overall financial planning thing. So there's small things I think can be fixed. There's also the US, I think there's really interesting technology solutions to help people with deferral rates and with getting out of the default, and thinking about what portfolio is the right optimal strategy for that client. My husband won't get out of his default, and he's in his mid-50s, and I mean his allocation to bonds might turn out to be great in the next couple of years, but it's been an absolute disaster over the last decade. But because of the charge cap and about who's paying for what in a UK pension, those tools haven't been widely available to investors because they have to pay for it themselves. It's not offered typically as part of the plan, and I don't know how that compares to the South African experience. So sorry, there's lots of information, but I hope I've sort of in a roundabout way answered your question.
Thank you.
Just while we're on that subject, and before we move over to another really important topic that I want to cover, can we just talk briefly about the consumer, the actual end client, the recipient of the advice? Post RDR, we've got different propositions, we've got different technology, we've got tighter regulation. What about the actual customer? Is there much work done in South Africa on sort of evidencing and researching how the end customer has benefited, in brackets or not, from RDR?
I'm not sure you posed that question to Emma. So.
Sorry, Kevin. I'm looking at you, and nobody knows that. So yeah, please.
Yeah. In fact, we asked that question, funny enough, to the Financial Planning Institute to say, as financial advisors have to go through this process of, certifying and getting so many certified points in order to maintain their professional status. And we said to them, as the professional body, is any work being done on the consumer, now stating that, you've seen some kind of significance of that, this ongoing education has actually led to better consumer, or improved consumer outcomes. And the answer to that question was, no, it's not the kind of work that the Financial Planning Institute does. Certainly, I've not seen evidence of any stuff coming out of our financial services sector either. So FSCA in South Africa, to the best of my knowledge, Caroline, I'm not sure if you've seen anything. And I'm not sure whether, proprietary in the large, normally if an entity is going to do that in South Africa, it tends to be the large life offices that have an actuarial evidence-based approach to this. I haven't seen much evidence of that coming to the fore either. So again, the cost of regulation input relative to the consumer benefit, I think the jury is still very much out in South Africa as to what that benefit has been, by and large.
Carolyn, do you want to add anything from a client perspective? Have you heard any rumblings around the end customer and the usability around value for money, anything like that?
I think people are just very anxious whenever we talk regulation, because they just think it's almost a grudge purchase. It's something that they have to do, but they're not entirely sure what the benefits are that are reaping through, which is exactly what Kevin has just highlighted. You know, our conversations with them are all the usual familiar terms: digital proposition, automation, transparency of service, operational efficiencies, you know, and a lot of that is driven by RDR. But at the same time, a lot of it is actually a result of the market pressures from COVID, which has accelerated the need for these types of changes. So I think initially it was more of a grudge because it's regulation kind of highlighted, whereas now people are realizing a lot more of the need around some of these terms due to how their businesses were having to operate under the COVID regulations. So I think that's where they're also seeing they can piggyback off it to get the benefits that they actually need to see.
Yeah, exactly. And Heather, I think you and I probably both agree that that's pretty much the same over here, that we probably don't focus enough on the customer and the outcomes. Have you got anything that you can add to that?
So the only thing I'll add is I think one of the challenges that the regulator has is that the financial advice community is really fragmented. So there's 5,500 odd financial advice firms, but about 80% of advisors work within firms with 5 or fewer client-facing financial advisors. It's a real people refer to it as a cottage industry. It's and so it's really difficult to supervise an industry that is so fragmented, and there's not centralized sources of data that they can access. They can get some from platforms and other providers, but they don't really want to be in the position of providing regulatory oversight for their customers, essentially. And I think that's been one of the real challenges for the regulator. And there's been some comments coming out of senior individuals at the regulator that feel that at larger firms, clients get better outcomes and better advice, which our research suggests that actually clients of larger firms are paying about a 23 bp premium for all of the costs, and particularly higher fees for products for the funds and solutions included within the portfolio. And I think that's a real challenge that needs to be addressed. And there's a lot more work that needs to be done to figure out how do you effectively supervise a very fragmented market when the potential for harm is significant, and it's really difficult to identify those points of harm. And so the temptation is to push people towards these bigger firms where there's senior managers who can oversee the behavior of those individuals. But actually, there's no evidence that the client outcome is any better in those. In fact, it might be worse in those firms.
If I can actually just jump in there.
Sorry, Karen, you carry on.
No, thanks, Kev. So just something from a technical aspect with touching on what Heather's just mentioned is what we are finding when it comes to technical conversations is that it's almost falling into 2 categories. There's no direct answer in how to almost solve for the needs to see the end outcome that benefits the client. There's no clean-cut view. So what we find is in some conversations, people are almost accepting the limitations of their back-end solutions and are trying to almost like wrap around with a few little specific areas of how to improve things to reduce their cost spend versus a re-platform. So you're getting those organizations that are saying, do we have to re-platform to actually achieve what we need to achieve? Others are saying, you know what, maybe we can just kind of fix little areas here and there that we feel are more of the gaping holes. But because there's no clear-cut outcome and benefit, people actually don't know what the cost and the value should be equated to fixing and solving for these type of requirements.
Yeah.
The point I was going to make, Emma, was I've obviously been in the industry for a long time, but I have an independent wealth manager that's appointed to look after my assets. I can't say with any certainty that the behavior that I've seen from that wealth manager, with the imposition of RDR, has benefited me as a consumer in any way. In fact, to the contrary, I mean, all I've had to do is to sign more paperwork, and that paperwork has largely been a tick box exercise. So it's like, financial needs analysis, to make sure that your needs are still the same from year to year, and so it doesn't mean that the advice, I'm now getting how would you qualify that statement that I'm now getting better advice as a consequence of RDR? And I can't see that. I can understand the need to regulate something that is, that where you've seen particularly bad behavior. And I think that was almost the regulators' approach initially, that and we still see this around, if you go to, a lot of the, if you go to Hong Kong or you go to Dubai, for example's sake, you'll see a lot of unregistered financial advisors that are selling, consumers with 7.5% upfront commissions. Well, guess what? That hasn't happened in this country for the last, 20 years or so. We've been on a fee-based model by and large. And I think those are, probably more closely aligned to consumers, that you can kind of see what you're getting, whether there's sufficient value in what the price proposition is ultimately. But I can't see how me, Kevin Hinton, as a consumer, with a wealth manager being appointed to me, how RDRs had any benefit to me whatsoever. Has it brought down price? That's debatable. I think free market forces have done that more so than regulation. So again, you've got to look at it from that point of view. If I'm the power of one, what is the power of many saying?
So just to disagree or challenge that, there's much more transparency for the customer about what they're paying. There's very little evidence that the customer looks at that. But what we see is that financial advisors look at those fees really closely, and there's an ability to compare. I think there's also, it sounds like you have a really good wealth manager who's charging on a fee basis, and so that's great. But not everyone was in that situation. And I remember going into my bank to open a mutual fund account in Canada a long time ago, and I kept asking, how are you paid for this? Oh, it's free. There's no charge. And I was like, at that time I was young and I knew that was absolutely rubbish. And so I think it, in terms of fostering a sense of trust and getting other people to not, people prefer to talk about their sex life than financial services. They prefer to do the hoovering than talk about financial services or manage their finances. And maybe if it doesn't seem, for outsiders, if it doesn't seem quite as murky, and then maybe that's a good thing. Even though if I get your experience is really different, because it sounds like you have a financial planner or wealth manager that's done a really good job for you. If you think of people who aren't familiar with financial services, you're just seeing that fee line for, I'm paying my this person to advise me, and they're doing that in my best interest. I think that can make a difference to the perception of the industry.
I think
I totally agree with you, Heather. As I said, I'm the power of one, I'm not the power of many. So I probably concur with you that is the case. But wherever you look around the world, the average IQ of financial service related matters is particularly low. And despite the fact, all the consumer education that takes place around it, it's not the same kind of interest as you'd have. You've just made the reference to sex. I'm going to do that as well. It kind of, people aren't as interested in financial services until things go wrong, kind of stuff. So, people also have that obligation and responsibility in their own right to ask the right questions, to get the right answers to what it is that they're buying ultimately as well. Much like you'd ask, any other consumer, goods or services, what the price makeup is ultimately. So,
listen, I'm going to jump in because we're coming to the end of time, and I don't want us to cut off at the wrong time. We did have a number of other topics that we'll discuss over this forum another time, but all very related to the excellent conversation that we've had on RDR and the regulator. And I think if I just go back to the title of this, how I envisaged this session was about evolution and revolution. And I think that's exactly where we've left it, because I think we are in that period of evolution, because whether that's bringing fees down, whether that's engaging the end customer so that they are more aware or more able to help themselves with financial advice, or from our point of view, from Bravura's point of view, that actually we can help them with some of those technology solutions that help them get engaged and help our clients engage them. And I think it's brilliant. I think that we've got a great panel here because there's so much insight from across the globe that we can only dig into further and further and further. So it just goes for me to thank Kevin, to thank Heather, and of course Carolyn as well. And thank you very much.